So the big question is this: how are gym owners like us who followed our passions, quit our 9-to-5s, and cashed in our life savings to open our tiny gyms? How do we grow our gyms in a way that helps us find our dream members, change their lives, make our big dent in the universe, and yet still remain profitable in the process? That is the question, and this podcast is here to give you the answers. Join me and follow along as I learn, apply, and share the strategies to grow my fitness empire using nothing but the day's best proven methods and tactics. My name is Will Hurst. Welcome to the Barbell Business Podcast. Hey guys, what's going on? It's Coach Will, and in this video I have a question from a gym owner in the Big Little Gyms tribe asking about the format of his business, the corporate structure of his business for his gym, which this is a question that we've gotten a few times over the years that's come up, and I've had quite a few gym owners ask me about it, what the best corporate structure is for a gym. And he's asking specifically here, LLC or S-corp. And I'll just read his question real quick, and then basically give my take on it, right? And just right up front, this is not like financial or necessarily financial advice or whatever you would consider that as a disclaimer. You at the end of the day should probably talk to either your CPA or your whatever tax lawyer, whoever you want to consult that does this professionally for a final answer. This is just more or less like my experience and what I've seen a lot of gyms do. Also, just going to give you some general advice between the two that is kind of well founded. So we started out as an LLC, but a lot of people say an S-corp is the way to go, especially when making a certain threshold. But from my research, it doesn't seem to matter, since you can deduct your pay for the S-corp, but the remaining amount still is a pass-through income, which isn't essentially the same thing. If you have experience, please share. Okay, so first and foremost, an S-corp and an LLC are not exclusive of each other. An LLC can be an S-corp. An LLC can take an S-corp election. I believe an S-corp, an LLC has to elect to be an S-corp in its first return or its first year in order to take the S-corp election, right? An S-corp is really just a taxable corporate structure. If an LLC takes the S-corp election, they file as an S-corp on the tax end, but as far as how liability is treated for the business, outside of taxes, they're still an LLC. They're still a limited liability company, right? And the difference between the two is in how shares are. The difference between an LLC and a typical corporation is in how it issues shares to the shareholders, right? An LLC is technically a group of people that get together and form like a corporate umbrella to limit liability that passes through to the person, right? Basically, if you're a single owner LLC, you're basically just forming a company to say you can't sue me personally, but you can sue my company. That's what you're doing there for a legal liability standpoint, right? The other option, if you weren't an LLC and you wanted to be a corporation that issued shares, which LLCs don't issue shares. LLCs are companies that are based on percentage of ownership, right? So if it's you and 3 other people that own the company, an LLC defines who owns how much by percentage in what's called an operating agreement, right? So you have an operating agreement, and you can say Doan owns 50%, and then these 2 other guys own 25% each, and you outline in the operating agreement how all the decisions are made, right? That's how an LLC works as far as corporate the operating agreement, right? A corporation is the other option. And I'm not saying S-corp. S-corp is just a taxable election. I'm just saying a corporation, or what's typically called a C corporation or a typical corporation. The operating agreement there is different. It's based on who owns shares of the company. All right, so you actually issue physical shares of the company and stock certificates for those shares, and you decide how many shares the company has. You could say it has 20, or you could say it has 1,000. You could say it has 1,000,000 shares if you want to. Right? And you can say that that person holds 5. If there's 20 and I hold 10, and then I hold 11 and the other person holds 9, then because I own the majority share of shares, I have more voting rights. Basically, I have more votes. Each share can be a vote, basically. Right? Because every shareholder gets a say in the company's direction when it comes to shareholder meetings. Right? So it's just a difference in how you're dividing up. It's kind of the same but different, right? Just a different way of saying who owns a percentage of what. If you're going to be selling shares of your business to different ownerships, a typical corporation makes more sense, because it's very easy for someone to sell their shares to another person and transfer it, versus an LLC. Generally, it's hard to sell percentage. You can't really sell percentage. You have to basically sell your stake in the company and write a new operating agreement that's saying that this person no longer owns this percentage, this new person does, right? So that's the difference as far as like how the shares of the company are divided up. And either type can be an S-corp. A classic corporation, or typically called a C-corp, can elect to be an S-corp as well. An LLC can be an S-corp as well. That's simply a tax structure election, okay? Now, what the difference is an S-corp is basically pass-through, right? So, and LLCs are actually very, very similar, where basically you're getting taxed. I guess the difference is, an S-corp is basically like, the best way to describe this is the company makes $1 million, right? Company makes $1 million, and after everything's paid for, and say it's paying you $250,000 salary. Okay, so that $250,000 salary gets deducted from the $1 million. The company made $750,000 profit, right? Now, if you were an S-corp, that $750,000 profit would just pass down to me as well. So I would get what's called a K1, basically, for the $750,000. So it's basically pass through, right? Now, where this gets interesting is if you're multi-owner, say there's $1 million profit left, and you're deciding how everybody's going to get paid, you could say, okay, this shareholder also works a job in the business as the CEO. And the CEO role gets $250,000 a year in pay, right? And then this owner here is going to work as a secretary and make $100,000 in pay. So now you have $350,000 in payroll against that $1 million. That leaves $650,000, right? If you're tracking on the math. Now that $650,000 remaining passes through to the shareholders based on how many shares they own, separate from what they're paid as salary, right? So that's how it's different. Or that's how an S-corp would work, I should say. Now, a typical corporation, if they weren't filing as an S-corp, and I believe an LLC works very, very similar, is that there's a corporate level of taxation, and then there's an individual level of taxation. Whereas an S-corp is always all passed through the individual level. There is no corporate tax. Whatever is made by the company, in addition to salaries paid by the owner, are basically passed through to the owner, and all the taxes are paid at like individual income tax rates, not corporate tax. With a typical corporation, how it works, if you weren't taking the S-corp election, you were just a typical corporation, then you would say you made $1 million profit and you paid yourself out of that a $250,000 salary, right? Then you would have that $250,000 salary that you pay individual income tax on at the individual level, right? The remaining $750,000 that stays in the company would now be taxed as a corporate tax. The company would have to file a tax return. Actually, at both levels, a tax return is filed, but that wouldn't be passed through to the shareholders. The company would pay corporate tax rates on that profit, and that company would retain the profit, whatever's left after it's paid, in its operating accounts, because it's not passing through, right? It's not passing through the company. It's the company's money. The buck stops there. That $750,000 profit is taxed whatever corporate tax rates are. There's not a K1 issued, right? Okay, so hopefully that makes sense. And that's the difference in these two things. An LLC, let's see, we can chat GPT this real quick. And because I'm not sure, because I've only ever elected as an S-corp. So do LLCs, and I believe it depends on whether or not you're a single member or a multiple member LLC, right? So if you're a single member LLC, technically as far as taxes are concerned, you are not, like, the LLC isn't even acknowledged. It's basically all passed through anyways. If you're a single member LLC, if you're a multi-member LLC, I believe it's different. So I'm gonna chat GPT that with you real quick to clarify that for myself and for you guys. So do LLCs that do not take S-corp election have pass through taxation? Yes. LLCs that do not elect to have S-corp generally have pass-through taxation. It means that the income deductions and credits of the LLC pass through the individual owners. Members then who report these in their personal tax, the LLC does not pay federal income tax. The members do, based on their share of the profits and losses. This allows the income to be taxed at the individual level rather than the corporate individual levels. So we can ask it, okay, why would an LLC elect to file as an S-corp? That's actually a really, really good point. Self-employment taxes. Yeah. So really interesting. And this definitely gets a little bit advanced. And again, this is something for you to discuss the final answer on with your CPA or tax lawyer, whoever you consult with for like your tax structure. I'll just share with you why we have done it. Is because if you are an LLC and you don't take the S-corp election, all the taxes do pass through just the same. But you as a person are now fully responsible for all of the what are called corporate the self-employment taxes, which are Social Security and Medicare. For example, when you are an S-corp, your company pays half of those things, right? Which I believe right here, Social Security and Medicare end up being around like 12 or 13% in total. Now, if you're filing as an S-corp, your company pays half of that versus it passing through to you. Now, at the end of the day, if you're the only person in your business, then it's going to be the same either way because your business is paying it over there and then passing the rest through. But in the situation where you have like multiple employees, like we do, there's actually tax benefits to my company paying half my Social Security and my Medicare as me being an employee of the company. Right? And then I also get paid on the pass-through profits over and above my salary being paid as well as everybody else's payroll, right? So I found that generally if your business is going to scale up and you're going to have multiple employees and you're going to have a bit of a staff, generally it makes sense to take the S-corp election. So basically, your company, and I pay myself on W-2 as an employee for my job for the company. As CEO of Big Little Gyms, I take a paycheck and it goes through payroll provider, and my company pays half of the self-employment tax, which are Social Security and Medicare, as it would for anybody else who works for my company, right? Because that's actually, if someone works for you, you as an employer have to pay half of Social Security and half of Medicare, which ends up being like something like half of the 12%, which is like 6 whatever percent. It's about 13%, I want to say. 6.5% would be half of that, right? So there's a benefit there on the tax end having it work that way. So that would be your benefit there. So just to kind of clear that up, generally, and I ran my gyms as LLCs that filed as S-corps. That was my election for these exact reasons. Both of my gyms had, multiple employees and payroll, and I was putting myself on payroll as an employee so I can get the benefits of being an employee for a company while also being an owner, right? Because you as an employee will get a W-2 paycheck with this matching. You can set up a 401k. You can have corporate matching to the 401k and take pre-tax money from your company and pay yourself because you are an employee that works a role. And then if your business makes more money than the salary it pays you, say you pay yourself $100,000, but your company makes another $100,000 after paying you, you now get that pass through of that K1 to yourself, right? You get that pass through that K1 of those profits as well to yourself that you have to pay taxes on afterwards. So yeah, that's my experience with it. That's my thoughts on it, and that's what I have done. I would, of course, if you have other ways you have done it for your gym or you found benefit to do another way, I would love to know if there's a corporate structure that's benefited you. Because as your business grows and as you make more money, you'll find the biggest cost you actually end up having ends up being taxes, right? As you're growing your business, your costs, you don't make a lot of profit, so taxes are not a big concern because when you're only making, say, if I pull the tax brackets up here, let's see, what are the tax brackets? Okay, if I pull those up, for the United States anyways, even if I make 100K, say I pay myself 80K this year after everything, my taxes are only 22%. If I'm married, then it's, if I can make 100K, if I'm married, if that's our only income, it's only 22%, right? So 22%, of my profit might only be if it's 100K, 20K that year. right? Or a couple $1,000s a month if we were to break it down into monthly taxes paid, right? Versus, payroll when you're a small company is probably going to be more than 20K. Shoot, it can be 20K for your month, right? So, but as you get bigger and say you start making $400,000 a year with your gym, because you become profitable and you scale the business and you have a team and you're generating a lot of cash flow. Now you're in a 32% tax bracket on that, say $400,000, which is now like $150,000 a year in taxes you're paying, right? So you do start to think, and it's something we often don't think about when we're small because the tax burden isn't enough to influence our decision making, which sometimes causes us trouble later as the business does scale. You're like, oh, I wish I would have set the business up like this, because now I need to go start another company essentially, and in the meantime I can't go backwards. Once you make a bunch of money and you file under that corporate structure that you have in place already, you can't undo it. You can't go start, because I'm paying taxes in 2024 for my 2023 tax year. I can't start a new company today and retroactively pay taxes with that tax structure. I have to pay taxes into the tax structure that was already in place in 2023 when I made that money in that company, right? So you do want to think about setting your business up with the tax structure and the corporate structure that's going to be the best for your business as it scales. And you generally want to think about, you don't want to have to change that later. I've made that mistake with a couple of companies now where I did not pay attention to, should I file as an S-corp? Should I file it this way? And it also can, when it comes to selling your business as well, can be trickier. Definitely, I would say LLCs with the S-corp election for my businesses so far, my personal experience, have worked very, very well for the tax structure. But when you go to sell an LLC, it's not as easy. A typical corporation with an S-corp election might be easier to sell because it's just shares. And you can just sell your shares to anybody. You can just be like, hey, do you want to buy my shares? Okay, I have 20 shares, 20 pieces of paper. These are worth $5,000 each. You want to buy all 20? Okay, that's $100,000. Okay, you give me $100,000. I give you all my shares. You own my company now. Simple, right? Pretty much straightforward. Company that person now holds the influencing decision making. As long as you document that the shares were sold to them, so that way if there's ever a legal case, you can say, hey, here's the transaction, here's the money, he has the shares, we've documented that in a ledger, we're good to go. Versus an LLC, if you sell your company, then you have to rewrite the operating agreement. You have to have more, I've invested in a couple of companies now that were LLCs, and the operating agreement just requires more conversation and back and forth on different points in the operating agreement. It's totally open for interpretation as to how things happen in LLC based on what's in the operating agreement. You can say whatever you want in there, and whatever you say in there is how the business has to run and how decisions have to be made. And it can say things like, it doesn't matter who owns the most number of shares, we're always going to vote this way, right? It's pretty much how it goes. So there's two different questions you're asking when you ask about business structure, corporate structure. There's the tax side as to how you should structure the company for tax purposes, and there's the operational side as to how you should structure the company for operations and there's also probably a third question there okay, exit and selling the business one day, if that's something you're thinking about, which you may not be. You might decide that your gym at the end of the day, whoever buys it might just be an asset sale and I'm just going to dissolve my company, which doesn't mean the business closes. An asset sale means you're selling the assets of the company, which can be the customer list, the equipment, the physical space. That can all sell as an asset and not necessarily under the same EIN or corporate structure. And that new buyer can just start a new LLC or a new company themselves and just take your assets on. And essentially what you're selling that person is the pieces of the company, kind of like how you would sell a car, right? You're okay, the car, I have a title, there's a bill of sale. The bill of sales says you're going to give me $10,000 and I'm going to give you this title. You said both sign the bill of sale. You give me $10,000. Because you signed the thing and we've engaged in the transaction, I now have to give you the title. You now own it. I sign off on it. You take it to the DMV and you put the title in your name. I relinquish my ownership of the car to you. That's what that is. That's what a asset sale would be like. Would be more the hard parts of it, right? Versus the corporate, if you were to sell it as a full corporate business sale, you'd be selling pretty much basically everything, not just the hard parts, not the customer list, not just that, but also, you know, they're going to get all the tax records, they're going to get all the P&Ls going back, the corporate account with all the cash that's in it goes with the business. So that's, again, something to think about in your corporate structure, and how you want that to work. I find probably for most gyms and for my gyms, I should say specifically, I found that the LLC with S-corp election was here in the United States was the best structure for me, because when I did sell my gyms, I sold them as an asset sale. I did not sell them I was not selling them my corporation. I was selling them the assets of the corporation, and we evaluated the value of those things just the same anyways. I basically said, like, these assets are worth this. The customer list produces this much revenue, so you're going to play this multiplier of valuation, and that's the price, right? I'm not selling you I'm going to basically dissolve this EIN. I'm keeping the cash that the company made, and you're going to go take this customer list and everything going forward, and you're going to make your own money with it under your corporate umbrella. And that's better, because then you don't get into like having to like assign over a company to the IRS and the EIN and all that stuff, which isn't, I don't think, that big of a deal either way. But for a small business, I just think it's kind of overkill. And again, that's my personal opinion, and not financial advice, of course, for you to say, I'm going to follow that blindly. That's for you to maybe take to your legal tax advisor, whether it be a CPA or tax attorney or whoever helps you structure these things, to make the final decision on what's best for your particular situation. So that's it, guys. Hopefully you find that valuable. If you did, throw me a comment or a like or whatever. See you guys later. Bye.